On the ban on residential real estate purchases by non-residents, I suppose it would be surprising if the IMF welcomed anything that smacked of a capital control. But the way you put it is interesting. You say foreign buyers seem to have played a minor role in the markets recently. I think seem is right, the data on this is not good. And the tense is absolutely right. But the concern behind the policy, I think, is partly about what happens if China were to liberalise its view of its policy on capital outflows, and a tsunami of money came towards the market that was years away from being in any sort of equilibrium. So what would you say to that concern? How real do you think it is? And does that make a difference to your view about the appropriateness of this ban?
So you found there's a reference, I think, to the institutional view on capital flows of the IMF, and I think the institutional view is on liberalizing and managing capital flows, just to give you some context. So I think there is a recognition that capital flow management measures may be part of the macroeconomic policy toolkit. So, and I think a core sort of principle or philosophy in the institutional view is that capital flow management measures can be appropriate if there's a capital inflow surge. And then the IMF, again under the institutional view, would suggest temporary and targeted measures. So in that sense, yes, the situation could change. Sort of, in terms of the big picture, I think as far as housing is concerned, I think the shift in investor preferences towards real assets, including residential real estate, I think is partly contextual. And in this sense, it was difficult global recovery, quite expansionary monetary policy in the major advanced economies, and in a very weak global recovery, and continued relatively high desire to save across the globe, very low interest rates. Clearly in this context, many real assets have become more attractive, and that has been the context. Going forward, we think that context is different, but there may be other factors. So in that sense, we would argue a ban is a very definitive measure, but there would also be a possibility to respond if there were a renewed inflow surge, that there would be scope to respond.
You mentioned that further Jason from interest.co.nz. You mentioned that further relaxation of LVR restrictions beyond those that became effective on January 1st this year would not be helpful under the baseline outlook. And I was just wondering if you could expand on that a little bit.
I think the view is, the number of criteria where when you think that relaxation may be appropriate. I think on the one hand, you would think that risks would decline in balance sheets, both households and in the financial sector at large. You would also think if there's little risk of sort of the relaxation rekindling a boom. And then third, I think another criteria is whether the relaxation is needed also to relax housing frictions, which would primarily be in a sharp downturn. So in current circumstances, I think as we argue, we're not that worried about rekindling a boom. I think under the baseline, we would expect with the policy agenda in place that house prices would sort of grow in line with the general price level. But we note that household debt is high, that on the bank balance sheet mortgage assets are relatively high, and from that very high level there is a level of risk remaining, even if some of the higher risk loan, the share has been reduced. And then we would not see under the baseline a need from housing market conditions to sort of avoid that the restrictions sort of amplify frictions and complicate the adjustment.
And you mentioned LVRs here, but what, did you do any research or any undertaking of anything to do with debt-to-income ratios?
We continue, I think, to think that it is useful to have this instrument in the toolkit for the Reserve Bank, and then at the moment I think there will be no need to put or use that instrument. But I think the key point is, as the market has cooled, a welcome cooling, this is also time to update the toolkit.
So it's important for them to have the option to use it, but not necessarily to put it into force.
Yes. As argued in last year's FSAP, I think when it comes to housing markets and household balance sheets, it's useful to have a mix of tools. If you only have effectively one instrument that is suitable for that purpose, the LVRs, you can use the instrument maybe a bit in excess, which may have unintended consequences, right? So in that sense, some LVR restriction to a healthy level is, we think, has been useful. But then, if there were another boom, it would probably be helpful to focus on other risk dimensions, in particular related to debt to income, or in a flow terms, debt service to income.
And you mentioned in excess just in your comments there. Do you think that the tool has been used to in excess within New Zealand?
It hasn't been used in excess, but I think it has been sort of used to the max, as we argued last year. Indeed. You know, it has been relaxed slightly as of January 1. But in that sense, if for any reason, you know, the housing boom were to rekindle, or for other reasons, household debt risks were to increase again, probably it would be helpful to have another instrument to use, rather than, again, only rely on the LVR restriction.